Good afternoon and welcome to BizTech Asia's Asian Midday Market Watch. It's Thursday, the 2nd of May. I'm Halley and my co-host today is Samantha Voon, returning from holiday. Welcome back, Samantha.
Good to be back.
And our guest today is the inimitable David Kuo, the founder of the Smart Investor in Singapore. David, welcome to the show.
Yes, good afternoon, you two. Yeah, nice to have you back, Samantha.
Good to see you again, David.
And Samantha is now going to lead in with us with the market moves around Asia today.
Yeah, let's look at the market. All right. So we have the Japan Nikkei 225 down 0.03%, the Shanghai Composite down 0.26%. In Hong Kong, the Hang Seng is up 2.34%. In Australia, the ASX is up 0.36%. The South Korean Kospi is down 0.14%. In Singapore, the STI is up 0.27%, while in KL, the KLCI is up 0.02%. David, I am sure you are not liking this. What do you think about the market performance today?
Well, I tell you what, Samantha, it is what we call an MB, yeah? That stands for a mixed bag, right? If you have a look at the market over in the Hang Seng, I mean, the stock market there has been driven primarily by property stocks that are doing very well. So right at the top of the leaderboard are many property stocks. So people are probably thinking that maybe property in Hong Kong is looking a little on the cheap side, and so less shares. Now, slightly different here in Singapore. The market has been driven primarily by the banks. And up at the top of the leaderboard are Singapore's three banks. And over in Malaysia, the banks are doing well. I have to also acknowledge the extraordinary results from Fraser and Neave, FNN. I mean, double-digit growth in profits in the first quarter. This company has attributed, well, first half rather, this company has attributed its strong performance to the last few years of strategic development that they've actually sort of put into the business. And I've been a long-term shareholder for Fraser and Neave. And the last few years hasn't been particularly great. But you know that the company is doing something. I mean, from integrating its farms, having its own dairy herd in order to produce a more sustainable supply chain of milk. I mean, all of that is now beginning to pay off. And for those long-term shareholders like myself, we've been duly rewarded. So, yeah, a bit of a mixed bag in the market today, Samantha.
Let's deal with the elephant in the room, David, and that was the Federal Reserve meeting last night. Before we circle back more to Asian stocks, and I know you're rubbing your hands with glee at the thought of that one. Last night we had the latest FOMC decision. It was unchanged, but it did cause some stir in the market. Can you take us through what the Fed actually did and what Jerome Powell actually said?
Yeah, okay. It wasn't so much what the Federal Reserve did, because it did absolutely nothing. It just left interest rates, as you quite rightly said, where they were before, between 5 and 5.25%. But it is really what Jerome Powell had to say in his conference subsequently that I think, depending upon who you are, whether you're a hawk, in other words, you want interest rates to either remain high and stay high, or you're a dove and you want interest rates to start coming down. You heard different messages. And that is the beauty of the Fed chair. He can say things through both sides of his mouth at the same time, and you can take away whatever you want. Number one, he said that inflation is not coming down as quickly as they would like. So therefore, interest rates are likely to remain high, although he said it is unlikely that interest rates will go higher. Unlikely. Then on the other hand, he said that the economy is doing reasonably well, and over time, he would expect the current interest rates to have the effect on inflation and will start to gradually sort of bring down the cost of living index, the CPI numbers. So I think we're going to be where we are at the moment. I think it's unlikely that they're going to be cutting interest rates, although experts still seem to think that there may be one interest rate cut by about November time. But unless the numbers behave themselves, I don't think that's going to happen. And those numbers I'm talking about are things like the payroll numbers that will be coming out, the inflation numbers itself. You'll also be looking at wage growth, and that seems to be quite strong. Then, of course, you've got the GDP numbers that are looking quite strong as well, although they're coming off the boil slightly. So many things for the Fed to ponder at the moment. And let's not forget, you talked about the elephant in the room. The biggest elephant in the room is, of course, the election, the presidential election towards the end of the year. And generally, the Federal Reserve doesn't really like doing anything around election time because they don't want to be accused of being partisan in any way.
It really has been a theme with our guests over the last couple of months that last little bit of inflation was going to be tough to get rid of. And I think that's a pattern that we're seeing in not just the United States, but in other parts of the world. And it's amazing how the world's changed from 4 Fed rate cuts being priced into futures in January and February, and now we start hearing mumbles about tightenings. David, let's move back to your happy place, Asian stock markets. The bank that always seems to keep on giving, DBS, Development Bank of Singapore, Singapore's largest bank, reports blowout results today. What is your feeling about banks in this environment? Are they still an attractive investment?
Well, the thing is, there were many analysts out there who were very pessimistic about banks, primarily because of what we were talking about earlier. In other words, the Federal Reserve cutting interest rates, and that would have a knock-on effect on banks, because banks generally enjoy the big interest rate differential, which allows them to make lots of money through that net interest margin. And what it appears to be in the case of DBS is that the net interest margin is holding up. The profits for the bank have actually grown in double digits. The amount of fees that they charge, particularly wealthier customers, is rising. So all in all, I mean, it was a good set of results for the banks. And of course, today, as I mentioned earlier on, the Singapore market was driven by the 3 banks. So people are now expecting similar results to come out from OCBC and also UOB. Over in Malaysia, we had Maybank shares were actually up today. We also heard from HSBC only a couple of days ago. Their results were astonishing, quite frankly, and it looks as though they're going to be resuming their quarterly dividend payouts. We'll be hearing from Standard Chartered a bit later on today. So I think in general, banks are doing all right. And when you have a look at the banks, the valuations, I don't think is really that expensive. Generally, I like to buy banks when nobody loves them. And of course, I've been accumulating HSBC shares over the past couple of years when everybody didn't really like HSBC at all. But then all of a sudden, it's come back. Similarly with DBS, I accumulate the shares when nobody likes them. And of course, now the PE is about 10, which is, I would say, not particularly expensive, particularly when you have a look at the dividend yield, which is still around sort of 5 or 6%. So for an income investor, it looks attractive, very attractive, Jeff.
So let's take a look at Starbucks, right? So Starbucks shares fell more than 12% after reporting its quarterly results. What prompted the drop, and was it justified, David?
Well, I am a Starbucks shareholder as well. So whilst I've been delighted with DBS and HSBC, I was a little bit concerned about Starbucks. But having said that, I think what Starbucks said when it came out was that they were being hit by a double whammy. First of all, the conflict in the Middle East has not helped them at all, because people have this perception that maybe Starbucks is kind of pro-Israel, and consequently, there's been a lot of customers who have boycotted Starbucks. Then, on the other hand, they have China. I mean, they put a lot of store in growing their brands in China, and they seem to have one main competitor in China at the moment that is eating its lunch, quite frankly. So you have Luckin Coffee, a very low-cost, affordable brand that is gradually sort of taking customers away from Starbucks. But if you remember, Jeff and Samantha, I've said many times on this show that when I look at data coming out from China, yes, you know, I have a look at the government data that comes out and tells me how employment is doing, how the GDP is doing, how that data suggests that things are kind of, but when you have a look at Starbucks results, it tells you a story. It seems as though the consumers in China can't even afford a cup of coffee anymore. So that paints a completely different picture to the one that we've been hearing from China, that you know, they're on recovery, everything is fine, and yet to say they are so stretched they can't afford to buy a cup of coffee. So always look at that kind of data. I mean, look at the numbers that come out from the likes of McDonald's, Kentucky Fried Chicken, Starbucks, and we'll be hearing from Apple. Apple is the high end of the market. Starbucks is what I would consider to be the affordable low end of the market, and all that together, and it will paint you a picture of the Chinese economy. And I don't think it's looking that great.
We were speculating off screen, David, that if they'd used the word AI in their results and release, we probably wouldn't have seen a 12% sell-off. But I can anecdotally say that here in Jakarta, Indonesia, they have been subject to quite an aggressive consumer boycott, them and quite a few other big, mostly American multinationals, European multinationals. So it wasn't so much of a surprise for me that they found some bad news there in that quarterly release.
Yeah, I know. And Samantha will probably sort of chime in and say that, yeah, in a kind of backlash against companies like McDonald's, maybe even Kentucky Fried, and maybe Starbucks as well, as a result of this war in the Middle East. And the sooner that is resolved, I think the better it will be for everyone. So I think the problems that Starbucks is facing in the moment is probably transitory. I love that word, transitory, and look how much trouble the Federal Reserve got into for saying transitory.
You had a shiver running down my spine when you said that. I'm like, no, please not, David.
That's all, it's just transitory.
David, thanks so much for your insights today. Always an absolute pleasure.
You're welcome. Thank you.
We've been speaking to David Kuo, founder of the Smart Investor in Singapore, on BizTech's Asian Midday Market Watch. I'm Jeffrey Halley.
And I'm Samantha Voon.
And this video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. You can also see it with our syndication partners and their TV stations, radio stations, and websites. Thanks so much for tuning in today.